Thanks for clicking. The Canadian economy added 150,000 jobs in January, shocking analysts who predicted that that number would be closer to 15,000. The much higher than anticipated job numbers come only a few days after the Bank of Canada Governor Tiff Macklem reiterated the bank's intention to pause on interest rates. Indeed, the news that Canada added 150,000 jobs will no doubt lead to further questions as to whether or not the Bank of Canada announced its pause too early. Canada's bond yields shot up on the job numbers, with investors thinking that the Bank of Canada might indeed have to go higher on interest rates in the coming months. So what I want to do today is go over the job numbers, discuss why this could be a big problem for the Bank of Canada, take a look at the historic lag between employment and the pausing of rate hikes, and then discuss what to look for next. We have a lot of big news coming out in the next few weeks, with Canada's real estate data set to be released sometime next week, and Canada's inflation data for the month of January set to be released the following week. We'll obviously have updates out on this channel on both. Click like and subscribe if you want to get those updates, but for now, let's get into these job numbers. Onto the job numbers. As mentioned, Canada added 150,000 jobs in January, crushing expectations that that number would be closer to 15,000.
Sorry to disappoint you.
And the bank is really not going to like what it sees with a 5% unemployment rate. Indeed, according to the bank's summary of deliberations, which was published this week, the Bank of Canada had considered pausing on rate hikes prior to the most recent rate hike, but opted to raise rates due to tightness in the labor market, meaning the 104,000 jobs that were added in December. And today's job numbers are no doubt going to lead to more predictions that the bank is going to have to raise further. Probably not instantly, but an acceleration in the number of jobs created, 104,000 in December and then 150,000 in January, is definitely not what the bank was looking for. And for good reason. Governor Macklem mentioned this week that the bank has been concerned with a wage price spiral, which we've talked about so many times on this channel, where higher prices lead to higher wage demands, which lead to businesses granting those wage demands and passing the cost on to consumers, which leads to higher prices, and on we go. So the Bank of Canada, through higher cost of borrowing, has been actively trying to encourage a higher unemployment rate to take the leverage away from the worker so they can't demand those raises, so we don't end up seeing a wage price spiral.
That seems fair.
And the bank and analysts were definitely predicting and hoping that these job numbers would have come in much lower. Indeed, the last time Canada's cost of borrowing was this high, the last time prime was around that 6.7% that we have right now, was in 2001, and the unemployment rate was sitting at 7.1%. With that said, Canada's employment rate, just like our inflation rate, is a lagging indicator. Historically, the unemployment rate can take a long time to go up after the Bank of Canada pauses on its rate hikes. If we look back to the late 1980s, when the bank raised rates by almost 4% within the period of a year, the unemployment rate didn't really start to shoot up until a year after the pause. On the other hand, starting in the year 2000, the bank lowered interest rates by almost 4% over the period of 2 years, and then it took another 2 years after that for the unemployment rate to drop only 1%. So, much like the inflation rate, Canada's unemployment rate really is a lagging indicator. Today's job numbers don't mean that they won't get worse in a couple of months, but on the other hand, the job numbers don't necessarily indicate that the Bank of Canada has done enough to cool inflation. What today's job numbers do tell us is that this isn't going to go as quickly as many are thinking. This isn't going to be the bank pauses on rates, we have a recession, inflation cools, and then we get another decade of ultra low interest rates and we're off to the races. Today's job numbers are an indication of a potentially very resilient economy and a potentially sticky inflation rate. With that said, the bond markets and the FX markets, the foreign exchange market, are definitely taking today's job numbers to mean the Bank of Canada will have to raise rates further. Canada's bond yields were already up last week on the news that the US had added 500,000 jobs and would have to raise rates further, and then popped up again today on the news of Canada's own additional 150,000 jobs. And it wasn't just bond yields. The Canadian dollar was also up on the job numbers, as FX traders expect that the Bank of Canada will have to raise rates, which will lead to a stronger dollar. So, in summary, Canada added 10 times more jobs than most analysts were expecting, which is going to put more pressure on the Bank of Canada to raise rates in the next couple of months. This doesn't necessarily mean that the bank is going to reverse its pause right away and go back to raising rates at its next announcement in March, but this isn't what the bank was looking for. This isn't going in the direction that the bank is hoping for, but that doesn't necessarily mean that it won't. Employment, Canada's unemployment rate, historically is a lagging indicator. So it could be a matter of time before this pause takes effect. But on the other hand, this could also be an indication of a resilient economy, an economy that still needs more slowing to come down from our central bank, an economy that still needs more tightening to come down from our central bank to get our inflation rate back under control. Whether or not the Bank of Canada will be able to sustain this pause is also going to be dependent on Canada's inflation data, which is due out the week after next. And we'll obviously have an update out on that inflation data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.